Over the Unrecaptured Section 1250 gain worksheet, which you can find in the instructions for Schedule D. So when you walk through Schedule D of your tax return, if you approach line 19 and your tax situation meets the following conditions, then you'll probably have to complete this worksheet in order to determine the amount that you'll enter in line 19 of your Schedule D. So if you checked yes on line 17, which indicates that you have both long-term capital gains from line 15 of the form and indicated your overall position is that you have overall gains in that you didn't have short-term losses that wiped out your long-term gains. If you have long-term gains and you have an overall gain, then you will select yes in line 17 of Schedule D, and then you'll need to complete this worksheet if any of the following apply. 1, you sold or otherwise disposed of Section 1250 property, which is generally rental real estate that you depreciated, and if you held that for over a year. Condition 2, if you received installment payments for Section 1250 property that you held for more than a year, on which you're reporting gains on the installment method. So if you're filing IRS Form 6252, then you might need to complete this worksheet. If you received a Schedule K1 from an estate or a trust, a partnership, or an S corporation that shows unrecaptured Section 1250 gain. Condition 4, if you received a Form 1099 DIV or a copy of Form 2439, which is undistributed long-term capital gains from a real estate investment trust or a regulated investment company such as a mutual fund that reports unrecaptured Section 1250 gain. Or finally, if you reported a long-term capital gain from the sale or exchange of an interest in a partnership that owns Section 1250 property. All of those conditions or any of those conditions will lead you to complete this unrecaptured Section 1250 gain worksheet so that you can properly complete line 19 on Schedule D. So we're going to go through this form step by step, or this worksheet. As a note, there are a couple of things. So one, if you had more than one property, as described on line 1, you're going to need to complete a separate worksheet for each one. And then you'll total the amount of all line 3 items. You'll enter that into line 4 of one worksheet. So let's go over this. In line 1, if you have a Section 1250 property in Part 3 of your Form 4797, for which you made an entry in Part 1, but not on Form 6252. So you reported this sale, but it wasn't an installment sale. Then you'll enter the smaller of either line 22 or line 24 of that property, which means line 22 being the depreciation, line 24 is the total gain. So you're going to enter the smaller of either of those numbers. So if you didn't have any of those properties, you'll go directly to line 4. If you had more than one property, you'll complete a separate worksheet for each property, and then you'll combine the line 3 items so that you're carrying forward in line 4 of only one of those worksheets. So in line 2, you're going to enter the amount from your 4797, line 26, for the property that you made an entry on. So line 26G, I apologize, that is the excess depreciation above the straight line method. So when you go through your Form 4797, you'll either determine that you use the straight line method of depreciation, in which case this would be 0, or you're going to enter the excess depreciation. So in this situation, we entered $25,000 that was the smaller of the depreciation or gain. And then in line 2, we entered $10,000, representing the amount of excess depreciation. So in line 3, we're going to subtract that. We come up with $15,000. So in line 4, we're now going to enter the total unrecaptured section 1250 gain that was included on either line 26 or line 37 from installment sales on form 6252. So line 26 represents the unrecaptured section 1250 gain on a regular installment sale. Line 37, which is so that would be in part 2 of form 6252. Part 3 would include the same information if you made the sale to a related party under the installment method. So that's line 37. So you're going to enter the total gain for that property that was held for more than 1 year right here in line 4. So in line 5, you're going to enter the total of any amounts that were reported to you on a Schedule K1 from either partnership or an S corporation as unrecaptured Section 1250 gain. So in this case, we put in $5,000, and now we're going to combine all 3 of these items, lines 3 through 5, and we get $25,000. In line 7, we're going to enter the smaller of either line 6 or the gain from line 7 on your form 4797. And then in line 8, we're going to enter the amount from line 8 of your 4797. This would be the non-recaptured net section 1236 or 1231 losses from prior years. So any unrecaptured losses, you would enter those here, and then you would subtract them from the line 7 number. So we arrive at $5,000. In line 10, we're going to enter the amount of any gain from the sale or exchange of an interest in a partnership that was attributable to unrecaptured section 1250 gain. So this would include your share of the partnership's unrecaptured section 1250 gain that would have resulted if the partnership had transferred all of its section 1250 property in a completely taxable transaction immediately before you sold your or exchanged your interest. So if you recognize less than all of the realized gain, the partnership will be treated as if it only transferred a proportionate amount of each property. In line 11, we're going to enter the total of any amounts that were reported to you on a Schedule K1, Form 1099 DIV, or Form 2439 from an estate, from a trust, from a REIT, a real estate investment trust, or a mutual fund or other regulated investment company, or in a connection with a Form 1099-R. So any of those amounts from a K1, Form 1099 DIV, Form 2439, or Form 1099-R. So in this case, we're going to enter $1,000. And then in line 12, we're going to enter the total of any unrecaptured Section 1250 gain from sales to include installment sales or other dispositions of Section 1250 property held for more than 1 year in which you did not make an entry in Part 1 of Form 4797 for the year of the sale. So an example of this would be any unrecaptured Section 1250 gain from the sale of a vacation home that you previously used as a rental property, but then you later converted to personal use before the sale. So to figure this amount, you would need to calculate, use some steps located in the instructions. So first, you would need to figure the smaller of the amount of depreciation either allowed or allowable or the total gain for the sale. And in step 2, you would reduce that amount by any Section 1250 ordinary income recapture for the sale, which you would find on line 26G of your form 4797. Step 3, generally your amount of capital gain for each installment payment is treated as unrecaptured Section 1250 gain until the total that was in step 2 of that has been used in full. And you would figure the amount of gain treated as unrecaptured Section 1250 gain for installment periods that you received in the tax year as either the smaller of the line 26 or 37 amount on your installment sales form, the 6252, whichever one of those sections applies, or the amount of unrecaptured Section 1250 gain that's still remaining to be reported. So that amount would generally be the total unrecaptured Section 1250 gain for the sale that has been reduced by all gain reported in prior years. So once you get through all of that, for example, we put in $10,000 as a placeholder based on those calculations. Now you've got figures in lines 9 through 12 representing all of these different gains. We're going to combine them in line 13 and we come up with $21,000. In line 14, if you had any section 1202 gain or collectibles loss or gain or loss, then you would enter the total of lines 1 through 4 on the 28% gain worksheet, which is covered in a different video. In this case, we put in $10,000. So section 1202 would be the exclusion of qualified or the qualified small business stock sale. So if you had any gain from that, you would enter that here. In line 15, we're going to enter any loss, if applicable, from line 7 of your Schedule D. So line 7, if you remember, is the short-term capital gain or loss. If line 7 is 0 or a capital gain, you simply enter 0. And then in line 16, you're going to enter your long-term capital loss carryovers from either Schedule D line 14 or your Schedule K1 if you are receiving a K1 from either an estate or a trust. And those long-term capital loss carryovers, you'll find them in box 11 of your Schedule K1 marked with a code D. And that specifically means final year deductions, that's the section, and then long-term capital loss carryovers. So in this, we put $5,000. You'll note that lines 15 and 16 are both in parentheses. That means that they're negative numbers. So when we combine them on line 17, we come up with $5,000. And then we're going to subtract the line 17 number from the line 13 number, and we arrive at $16,000. This would be the amount that you enter in the Schedule D on line 19. So if you are filing IRS Form 2555, which relates to foreign earned income, there's a footnote in the foreign earned income tax worksheet that you'll have to refer to, and you can find that in the Form 1040 instructions before you complete line 16. So be sure to do that before you start making those final calculations. That's all we have for this video. We do cover a little bit more detail about Schedule D overall in our video and in our article. I'll make links to all of those references and the forms that we discussed in our show notes. If you like our articles, please subscribe to our newsletter. And if you like our YouTube tutorials, please subscribe to our channel. And as always, if you have any questions or comments, please post them in the comments section. Thank you very much and have a great day.